Hi guys, welcome to my YouTube channel. Here I am back with another informative video. So the topic of the today's discussion is how high income earners avoid taxes legally in the US. So we will discuss here basically 11 ways for higher earners to reduce taxable income 2025. So this post was originally published on the December 17, 2021 and extensively then updated in 31st January 2025. When you earn a high income, you tend to pay a higher percentage of taxes than average earners. If you are a high earner, you might think you have no choice, that you must resign yourself to bearing a high tax burden, but is that really the case? The short answer is the no. At CMP, we spend a lot of the time with our clients, including clients with sizable income. So, discussing and working on the proactive tax planning. In fact, one of the most common questions we hear is this: what's the best way to reduce taxable income? So, or you may be wondering how to reduce taxable income. Don't worry, we will cover all that and more in this article. So the most common you make, the more money you make, the more complicated your taxes are going to be. So if you have a higher income than the most people, it's most important to work with a skilled accountant to figure out how to reduce the amount of income taxes you pay. In addition to taking your standard deduction and other deductions, there are many things you can do to lower the amount you pay. So overview of tax rule for the high income earners. If you are reading this post, you likely to read about the best tax deductions for the high income earners. We'll get to that, but the first let's start with an overview of tax rules for the high income earners. Specifically, the RMD age increased to the 73 for the individuals who turned 72 after December 31 December 2022, and who will turn 72 before 1st January 2033. It will increase to 75 for the individuals turning 74 after 31st December 2033. So raising the age for the required minimum distribution from the retirement plan account to 73 as the January 2023. The specific guidelines are for the individuals who turn 72 after the 31st December 2022 and who will turn 72 before 1st January 2033. In 2033, the age will increase 75 to those turning up 74 after 31 December 2032. Starting on 1st January 2024, the $1,000 catch-up contribution limit for the people over 50 will be indexed to the cost of living, eliminating the age limit for the contribution to the traditional IRA accounts. In 2025, the annual contribution limit for the 401k and the 403b accounts will be increased to the $23,500. For simple IRA, the contribution limit will increase to the $16,500. The maximum contribution for traditional and the Roth IRAs in 2025 will be continue to be the $7,000, as these limits are not adjusted for the inflation. In 2025, the social security wage base increase to the 1 lakh and $76,100, reflecting a 4.44% increase from the 2024 wage base of the 1 lakh and $68,600. This means that the earnings up to 1 lakh $76,100 are subject to social security taxes. In 2025, the income phase out range for the Roth IRA contributions increases to the 1 lakh and $50,000 to 1 lakh and $65,000 for single filers and heads of households, up from the 1 lakh and $46,000 to 1 lakh and $61,000 in 2024. For married couples filing jointly, the phase out range rises to the 2,36,000 and $2,46,000 compared to the 2,30,000 or 2,40,000 in previous year. In 2025, the IRS updates the tax deductible limits for long-term care insurance premiums for individuals aged 71 and over. The deduction limit increased to the $6,020 up from the $5,880 in 2024. For those aged 61 to 70, the limit rises to $4,810 compared to the $4,710 in the previous year. Self-employed individuals may still deduct 100% of their premiums using Schedule 1 of Form 1040. Those changes are significant because they make it possible for high income earners to make additional contributions to our retirement plan during the tax year. Later in this post, we will review potential changes that may affect high earners. 2025 federal income tax brackets. For 2025, there are 7 income tax brackets. Here's how they break down. This is the bracket 1 for the single filers, married filing separately, married filing jointly, and the single head of the household. This is the bracket 2, and the following is the bracket 3 and the 4, and then following 5, bracket 6, bracket 7. So IRS, what is the IRS definition of high income earners? For the tax purposes, the IRS defines high income earners as anybody who earns enough income to be in the top three tax brackets as outlined above. Those persons who are above in the above three tax brackets, top three tax brackets, they will be defined as the high income earners. That means if you earn more than 1,97,300 of taxable income as a single person, a married person filing separately, or as a single head of household, and more than 3,94,600 of a taxable income as a married person filing jointly. So you are considered a high income earner for the tax purposes. Tax saving strategies for high income earners changes the characters of your income. One way to reduce your tax burden is to change the character of your income. If you are wondering why you should do so, here are some of the ways if you can help lower your tax bill. Convert your simple or SEP or traditional IRA to a Roth IRA. If you are over the age of 59 and a half, and you meet the 5-year rule, Roth distribution are tax free because they are considered investment income, and they will increase your modified adjusted gross income MAGI, and which is used to calculate the 3.8% Medicare surtax. Or if you have a own business, and you may want to consider the structure of your business entity, particularly if you operate as a sole proprietor LLC or as an S Corp. The taxes, there is also a 20% business income deduction for pass-through entities. If you hire your children, you may be able to pay them without withholdings or matching payroll taxes. If you have a sole proprietorship, you should work with an accountant to determine if restructuring your business is worthwhile. Invest in our tax exempt bonds. Any interest you earn is not subject to the federal income tax and Medicare surtax calculations. Also, municipal bond interest for the bonds purchased in the state where you live is exempt from the state income tax. Consider investing in index mutual funds and the exchange traded funds. These funds are not actively managed and as a result can be more tax efficient than managed funds. These investments are an effective way to diversify the taxation of your income after the retirement. If you qualify for a health saving account, HSA, you have the option of investing the funds into the account instead of spending them on the medical expenses. Contributions are tax free and earning grow tax free. In the addition, if you use future distributions to pay for qualified medical expenses. The distributions are tax free. The overall benefit of changing the character of your income is that it can reduce your MAGI for the each tax year, and allow you to take advantage of a lower tax bracket in the same cases. So the first is case is to max out your retirement contributions. Let's start with the retirement accounts. Employed based accounts such as 401k and the 403b plans allow you to lower your taxable income easily. That's because every dollar you put into these accounts is not taxed until you withdraw the money from your account, and that reduces the tax burden each year you contribute. The benefit here is that if you wait until you have retired to withdraw the money from your 401k, your income will be lowered because you will no longer be drawing a salary. The result, you will be in a lower tax bracket. This means that the money you withdraw will be taxed at a much lower rate than it would have been if you had to pay taxes when you earned it. To take a full advantage of these tax reducing benefits, contribute the maximum amount. For 2025, the maximum contribution for 401k and 403b plans is $23,500. The catch up contribution limit is for the individual over 50 is $7,500, and the bringing the total contribution limit to the $31,000 for eligible participants. For simple IRAs, the contribution limit is about $16,500. However, for certain simple plans, the limit is about $17,600. If you are above 50, you can make catch-up contributions of $3,500 or $3,850, and depending on the types of the simple IRA. For participant aged 60 to 63, a higher catch-up contribution limit applies. $5,250 for the simple plans. Additionally, the IRA contributions limits for the 2025 remains $7,000 with a catch-up contribution of $1,000 for the individual aged over 50 and over. So the second the method is to the Roth IRA conversions. Roth IRA are the tax-free retirement accounts that can help you reduce your tax burden and save money on your taxes even if you are in one of the top brackets. Unlike a traditional IRA or Roth IRA, contributions are made post tax income. That means you will pay taxes before you contribute, but not with when you withdraw. So that might not seem like an advantage, but it is. Any income earned on the money in your Roth IRA is also tax free. You can even roll over the money in a traditional IRA or a 401k into a Roth IRA or a REIT, the same benefit. Some of the best times to do the Roth IRA conversions are when you have had a year with less income than the previous year, and when you have retired and are temporarily in a lower tax bracket. This strategy makes sense if you can wait until the age of 73 to make required minimum distributions. We like to suggest this option to our clients because it's easy to overlook. So the third method is to buy municipal bonds. Municipal bonds might not be the most glamorous investments, but can be a good option for high income earners. When you buy a municipal bond, you lend money to the issuer in the exchange for set interest payments throughout the bond. At the end of the period, the bond is mature and the original investment is returned to the buyer. The income from the tax exempt bonds is usually exempt from all the income taxes, including federal, state, and local taxes. Even the interest payments of your income may be exempt from the taxes. Of course, municipal bonds typically earn less income than other taxable bonds, but they can still be a worthwhile strategy for reducing your tax burden. You can decide whether they are worth it by calculating the bonds tax equivalent yield. So the fourth point is sell inherited real estate. If you have inherited real estate from a parent or someone else, You may not realize that you can save money on property taxes by selling the real estate quickly. Here's why. Let's say your parent bought a home for $200,000 and it's now worth $900,000. If they had sold it while they were alive, they would have paid capital gains on $7,000. If you hold onto the house, you'll have a stepped up taxes basis of $900,000. You could sell it soon after inheriting the home and pay little to no capital gains taxes. You should also know that you can avoid capital gains taxes by rolling the income from the sale into another real estate investment within 180 days. The fifth method is set up a donor advised fund. So this method, you already know that donating money to charity offers the opportunity for a tax deduction into the year the donation is made. So what you may not know is that you can get a deduction this year for a several years worth of contribution if you set up a donor advised fund. A donor advised fund is a charitable fund you can set up that allows you to decide how and when to allocate funds to individual charities. You can make contributions this year and take the full tax deductions this year on your tax returns, thus reducing your tax bill. Then going forward, you can decide how much money to donate per year and when to donate it. In short, you receive the tax deductions when you fund the donor advised fund. When the sixth method for this is to use a health saving account, HSA. You may also choose to contribute some income to a health saving account to save on your taxes. You may contribute only if you have a selected and a high deductible insurance plan. For 2024, maximum contributions are 4,300 for the individuals and $8,550 for the families. You may contribute an additional $1,000 if you are 55 or older. Health saving account contribution limits are linked to inflation. Even though cost increases for medical expenses typically outpace inflation every year, you can use the money in your health saving account for medical and dental expenses and related costs such as over the counter medications and the first aid supplies. If you withdraw money and use it for non qualified expenses, then you will pay tax and a 20% penalty on your withdrawals. You should know that the money in your health saving account is yours forever, unlike the money you contribute to a flexible spending account, which must be spent during the tax year. For that reason, you may want to consider an health saving account. You will not need to weigh the risk of having a high deductible plan against the potential savings. The seventh point is invest in companies that pay dividends. The income that you earn from your job is taxed at the ordinary income rates. The results is that you pay a high tax rate if you are a high earner. That you may know that the capital gains are taxed at a lower rate, meaning there are tax benefits to the earning capital gains. One way to do that is by investing in companies that pay qualified dividends. It's important to understand that ordinary dividends are the taxed as the ordinary income. To reap the tax advantages of the dividend incomes, you will need to invest in companies that pay qualified dividends, which must be issued by a United States company or a qualifying foreign company. You can find information about which companies are not considered to be qualified. If you have previously invested in companies that pay dividends, those dividends will be reported to you from 1099 div. Qualified dividends payments appear in the box ib. Ordinary dividends appear in the box 1a. Maximum federal tax rate for the qualified dividends is the 20%. So That was all about the strategies and the methods that would help you to reduce the tax for the high income earners. Hope this video will be beneficial for you. So do subscribe my channel for more helpful videos of this category.